Imagine waking up on January 1st, 2025. What's the headline gripping the nation? Is it UK interest rates crash, sending mortgage payments plummeting? Or UK interest rates soar, squeezing every last penny from your budget? This isn't just a hypothetical. It's a decision that will profoundly shape your financial future, from your mortgage repayments to your savings returns. Today, we're not just predicting, we're dissecting both explosive scenarios and arming you with a practical playbook to thrive, no matter what Threadneedle Street decides. And stick around, because I'm sharing my precise prediction and the single most crucial step you must take before the year is out. That knot in your stomach? It's the uncertainty surrounding UK interest rates. Every headline screams conflicting predictions, leaving you wondering, will my monthly mortgage payments become a manageable whisper or an unbearable shout? Will my hard-earned savings finally start earning a decent return, or will inflation continue to eat away at their value? The economic landscape is a whirlwind of rapidly shifting winds, from lingering inflation to whispers of recession. And understanding these tectonic shifts isn't just for economists, it's critical for every British household. This isn't abstract theory, it's about whether you can afford that family holiday, or if you'll be staring at another unexpected bill. The truth is, the volatility is unprecedented, and confusion is costing people real money. Have you already felt the pinch of recent rate changes? Let me know in the comments below. So, how do we navigate this minefield? We'll start by laying out the compelling, data-backed arguments for why rates could crash. Think recession fears and global shocks. Then, we'll pivot to the equally persuasive case for why they might soar, driven by persistent inflation and surprising economic resilience. We'll expose the winners in each scenario, unearth the global forces silently pulling the strings, reveal my own official 2025 prediction, and, crucially, hand you an investor playbook to protect and grow your wealth. But before any of that, we must address the elephant in the room. What happens if the UK economy hits an unexpected snag? Let's explore the chilling possibility of a rate crash. This isn't a fantasy, it's a very real scenario that could unfold if the UK tips into a deeper than expected recession. Picture this. Economic activity grinds to a halt, unemployment figures rise sharply, and businesses pull back on investment. In such a climate, the Bank of England's primary concern would shift from taming inflation to stimulating growth. They'd likely respond with aggressive rate cuts, driving down borrowing costs to inject liquidity into the system. We're talking about a potential fall to levels not seen since before the recent hiking cycle, perhaps even pushing towards 2% or lower. This would offer a massive lifeline to variable mortgage holders, potentially slashing their monthly repayments by hundreds of pounds, but it would also mean abysmal returns for savers. Furthermore, we cannot discount the impact of deflationary pressures, a sustained fall in prices, which, while seemingly good on the surface, often signals a severe economic downturn. Imagine consumers delaying purchases because they expect prices to drop further, creating a vicious cycle of reduced demand. The Bank of England would likely intervene with cuts to encourage spending. And then there are the black swans, unforeseen global shocks. A major geopolitical event, a sudden energy crisis, or an economic collapse in a key trading partner could send shockwaves through the UK, forcing the bank's hand to cut rates dramatically to stave off a full-blown financial crisis. Keep a close eye on retail spending data and the Purchasing Managers Index, PMI, for early warning signs of this downturn scenario. But what if the economy refuses to play by those rules? Conversely, the argument for rates to soar is equally compelling, perhaps even more so given the current stubbornness of inflation. Despite the Bank of England's efforts, inflation could prove stickier than anticipated, refusing to fall back to the 2% target. This might be fueled by continued strong wage growth, with workers demanding higher pay to keep up with the cost of living, creating a wage price spiral. If unemployment remains low and consumer spending holds up, the Bank of England could feel compelled to maintain or even increase rates further to exert more pressure on prices. They might even decide that the neutral rate of interest, the level at which monetary policy is neither expansionary nor contractionary, is higher than previously thought. Consider the underlying resilience of the British economy. Despite the gloomy forecasts, it has consistently defied predictions of a deep recession. If this resilience continues, with robust employment and steady demand, the bank might choose to keep rates elevated for longer, perhaps even pushing them higher into the 6–7% range to ensure inflation is truly beaten down. For savers, this would be a boon, finally offering decent returns on deposits, but it would be a punishing blow for new mortgage applicants and those on variable rates. This scenario also brings the potential for increased pressure on government borrowing costs, impacting future public services. The key indicators to watch here are the monthly inflation reports and average earnings growth. So, with rates potentially moving in such dramatic directions, who stands to gain and who loses out? The answer might surprise you. This isn't just about abstract numbers, it's about your monthly budget, your future plans, and the very foundation of your financial security. If rates crash, variable mortgage holders will breathe a massive sigh of relief. A 1% drop in rates could mean saving hundreds of pounds a month on a typical UK mortgage, freeing up vital cash for other needs. Those looking to buy their first home might find borrowing more affordable. However, savers, particularly those with cash in traditional accounts, would see their returns dwindle to next to nothing, effectively losing purchasing power to inflation. For investors, fixed income assets like bonds could see a boost as their yields become more attractive relative to plummeting interest rates. But what if rates soar? For homeowners on variable rates, the pain would be immediate and severe. Every percentage point increase could add hundreds of pounds to their monthly outgoings, pushing some to the brink. First-time buyers would find mortgages increasingly out of reach, dampening the housing market. On the flip side, savers would finally see meaningful returns on their deposits, a welcome change after years of near-zero interest. However, those with significant credit card debt or personal loans would face spiraling interest payments. And for investors, while cash offers a safe harbor, rising rates can depress the value of existing bonds and increase the cost of capital for businesses, potentially impacting stock market performance. Understanding these direct impacts is crucial, but they're not the only forces at play. Sometimes, the biggest drivers are thousands of miles away. The UK economy, for all its distinctiveness, doesn't exist in a bubble. Global forces often act as silent puppeteers, pulling the strings of the Bank of England's decisions. Think about geopolitical tensions. A conflict escalating in the Middle East, for instance, could send oil prices skyrocketing globally. This sudden surge in energy costs would feed directly into UK inflation, forcing the Bank of England to consider higher rates regardless of domestic economic performance. We saw this play out with the invasion of Ukraine. Similarly, major economic shifts in key regions like the US, Europe, or China can create powerful ripple effects. If the US Federal Reserve continues to raise rates, or if the Eurozone economy strengthens significantly, it can put upward pressure on the pound sterling, influencing UK import prices and, consequently, the Bank of England's inflation calculations. Conversely, a sharp downturn in China, for example, could trigger a global recessionary wave, leading to lower commodity prices and reduced global demand, which would then put downward pressure on UK inflation and potentially prompt rate cuts. Even factors like supply chain disruptions, a resurgence of global pandemics, or unexpected technological breakthroughs in other parts of the world can alter the global economic narrative and, by extension, the Bank of England's calculus for 2025. It's a complex, interconnected web, and ignoring the global ripple effect would be to miss half the story. So, after weighing all these intricate factors, what does my analysis suggest for 2025? Now, let's dig in. After sifting through mountains of data, watching the global chessboard, and listening to the whispers from Threadneedle Street, my official 2025 interest rate prediction leans towards a gradual, cautious reduction in the Bank of England's base rate, though not a crash. I anticipate rates settling in the range of 3.5% to 4% by the end of 2025. My reasoning is rooted in several converging factors. While inflation has proven stubbornly persistent, the underlying pressures are slowly but consistently receding. Global supply chains are largely healed, energy prices have stabilized relative to their peak, and the impact of previous rate hikes is still working its way through the economy, with a significant lag. Furthermore, I believe the Bank of England, while committed to its 2% inflation target, will become increasingly wary of tipping the economy into a deep recession. Data indicates a cooling labor market and a slowing, albeit resilient, consumer demand. They will likely adopt a wait-and-see approach, cutting only when robust evidence suggests inflation is firmly on its downward trajectory towards target, but before a severe downturn takes hold. This isn't a dramatic plummet, but a strategic de-escalation designed to prevent economic stagnation while still keeping inflation contained. Remember, no one has a crystal ball, and the future is always subject to change, but this is the most plausible scenario based on current trends and historical responses. Now, this isn't just about my prediction, it's about what you do with this information. Now, this is where we shift from understanding to action. Regardless of whether rates inch down as I predict, crash dramatically, or even surprise us by soaring, having an investor playbook is non-negotiable for navigating 2025. For homeowners, consider stress testing your mortgage. Can you absorb a 1 or even 2% increase in your monthly payments? Next, if not, explore locking into a fixed-rate deal now if it offers stability, or overpaying your mortgage where possible to build equity and reduce your loan principal, giving you more flexibility. For savers, if rates stay high or rise, prioritize high-yield savings accounts or fixed-term bonds. If rates fall, explore inflation-linked bonds or consider diversified investment portfolios that aren't solely reliant on interest income. When it comes to investments, diversify across different asset classes. Cash is king for emergencies, but a diversified portfolio of equities, real estate, and perhaps some commodities can hedge against inflation and interest rate fluctuations. If rates fall, growth stocks might perform better. If rates soar, value stocks and defensive sectors could be more resilient. For debt management, focus on clearing high-interest credit card debt now, regardless of the rate environment. A falling rate helps, but that debt is always a drain. If you have personal loans, explore consolidation options. This isn't financial advice tailored to your specific situation, but a set of strategies to consider and discuss with a qualified financial advisor. These steps are crucial, but there's one thing you must absolutely do before 2025, no matter what happens to rates. But before you implement any of these strategies, there is one fundamental action every individual must take to prepare for the upcoming year, serving as your financial bedrock. This isn't about market timing or predicting the unpredictable. It's about establishing an unshakable foundation, rigorously reviewing your personal budget, no excuses. Understand every pound coming in and every pound going out. Identify unnecessary expenses and areas where you can trim. Then, crucially, build or fortify your emergency fund to at least 3 to 6 months of essential living expenses. This is your personal safety net, your shield against unexpected interest rate shocks, job losses, or sudden expenses. Finally, understand your personal risk tolerance. Are you someone who panics at market volatility, or can you ride out the storm? Knowing this will guide your investment and debt decisions far more effectively than any market forecast. This single step, comprehensive personal financial review and emergency preparedness, empowers you to navigate uncertainty with confidence, ensuring you're ready for any future, not just the one you hope for. This isn't glamorous, but it's the most powerful financial move you can make. The urgency of preparing for 2025's financial landscape cannot be overstated. This isn't just about economic forecasts. It's about your peace of mind and your ability to control your financial destiny.
True financial resilience doesn't come from perfectly predicting whether rates will crash or soar, but from being prepared for either outcome. It comes from having a clear understanding of your own financial situation, robust emergency savings, and a strategic plan that adapts rather than reacting chaotically. Every decision you make today regarding your money is an investment in your future stability. Don't wait. Be proactive, be prepared, and empower yourself. Now, I want to hear from you. After watching this, which financial strategy are you going to implement first?
To prepare for 2025? Share your thoughts in the comments below. If this video helped you gain clarity and confidence, smash that like button. Subscribe for more practical financial insights designed for the real world, and share it with someone who needs to hear this message. Let's build a community of financially empowered individuals ready for anything. Remember, true financial security isn't about predicting the future with perfect accuracy, but about understanding the forces at play and taking decisive, intelligent action. You now have a clear picture of both the potential storm and the sunny skies ahead for UK interest rates in 2025, along with a practical guide to navigate either. Take what you've learned, apply these strategies, and build a resilient financial future for yourself and your loved ones. The power to control your financial narrative is in your hands. Act now.